It is Monday, May 5th, 2026. Let me walk you through everything that just happened to your money before you finished your morning coffee. The United Arab Emirates said it successfully intercepted multiple missiles fired from Iran. 3 loitering munitions were intercepted over the country's territorial waters. A 4th missile fell into the sea. This is the first time the UAE's missile defense system has been activated since the ceasefire began on April 8th. The ceasefire that everyone spent last week celebrating, the one that sent markets to all-time highs on Friday. That's ceasefire. The Washington Post oil responded immediately. West Texas Intermediate crude surged 4.39% to settle at $106.42 per barrel. Brent crude jumped 5.8% to $114.44. Reality. In the stock market, which on Friday was sitting at record highs and patting itself on the back, snapped back to reality. The S&P 500 slid 0.1 post and your mortgage just got more expensive again. Average 30-year mortgage rates are back above 6.5%, their highest level in over a month, as renewed Middle East tensions rock the bond market. The 10-year Treasury yield jumped nearly 8 basis points to 4.45%. CNBC, 1 missile interception. 1 morning. Higher oil, lower stocks, higher mortgage rates. That is the financial fragility hiding underneath every record high the market posted last week. And it just showed its face again before most people had poured their second cup of coffee. This is the story of May 2026 in one sentence. The market keeps trying to look through the Iran war. The Iran war keeps reminding the market that it cannot. Schwab's market analyst put it plainly, the market is mainly focused on earnings and may continue to look through the Iran situation until data suggests a higher probability of recession or stagflation. That is Wall Street language for, we are going to keep ignoring the war until we physically cannot anymore. And Monday was the war tapping the market on the shoulder and saying, hey, still here. NBC News. Now let's talk about the earnings picture. Because this is genuinely the one thing keeping the entire market from falling apart right now. And it is more impressive than most people realize. With 63% of S&P 500 companies reporting through Friday, blended earnings growth, including companies reporting and estimates for the rest, is an outstanding 27.1%. The 5% beat rate against expectations is ahead of the long-term average of 3% since 2001. That is a genuine, undeniable positive. Corporate America is making money, and making more of it than analysts expected, in the middle of a war, in the middle of the highest oil prices in 4 decades, in the middle of a frozen Fed and re-accelerating inflation. NBC News. The reason it is possible is AI. The 5 largest hyperscalers, Amazon, Google, Meta, Microsoft, and Oracle, are expected to spend $751 billion in capital expenditure in 2026, representing 83% growth versus 2025. This estimate has already been revised up from $673 billion, and from $546 billion, and from $546 billion. That spending is flowing directly into semiconductor companies, energy providers for those data centers, and the entire ecosystem around them. It is an artificial stimulus injected directly into the technology sector that is powerful enough to keep earnings growing even as the broader economy wobbles. But here's the problem with $751 billion in capital spending. It has to eventually produce a return. Markets are rewarding AI spending that shows near-term monetization, as seen with Alphabet, and punishing spending without clear incremental returns, something analysts criticized after viewing Meta's results. Expect sharper demands for AI return on investment disclosure next quarter. NBC News. The AI honeymoon is ending. Wall Street is no longer satisfied with "we're building the future." It wants to see the future paying rent. And the companies that cannot show a clear line between their AI spending and their revenue growth are going to get repriced. Publicly. Painfully. Now let's talk about the most absurd financial story of the week. Because you cannot make this up. GameStop. Yes, that GameStop, the brick-and-mortar video game retailer that became a meme stock in 2021, is reportedly making a $56 billion takeover bid for eBay. The company that sells used copies of games nobody plays anymore wants to buy one of the largest e-commerce marketplaces on the internet for $56 billion. GameStop said it has a highly confident letter from TD Bank for $20 billion in debt financing. GameStop CEO Ryan Cohen appeared annoyed with CNBC hosts when pressed on how the company would raise the remaining funds, saying it's half cash, half stock. The details are on our website. GameStop stock fell 8% on the news. eBay climbed 8%. CNBC. The market's reaction tells you everything. eBay went up because someone might pay a premium for it. GameStop went down because the market looked at this deal and immediately concluded it was either a joke, a disaster, or both simultaneously. A company with roughly $9 billion in cash is trying to acquire a company valued at $46 billion for $56 billion, using financing from a bank that apparently sent a letter saying it is highly confident. This is what financial markets look like when the money has been too easy for too long. When meme stocks survive long enough to develop ambitions. Now the number that matters most this week. Friday. The April jobs report. The U.S. economy is expected to have added just 50,000 jobs in April, far below March's blowout reading of 178,000. The unemployment rate is expected to have held steady at 4.3%. The Washington Post hears why this number is a trap in either direction. If the jobs report comes in strong above 100,000, it is good news for the economy but bad news for rate cuts, because a strong labor market gives the Fed less reason to ease. Mortgage rates stay high. If the report comes in weak, at or below 50,000, it confirms the labor market is deteriorating and the Fed should cut. But the Fed cannot cut into 3.3% inflation driven by an oil shock it has no control over. So weak jobs data in this environment does not produce rate relief. It just produces a Fed that is simultaneously watching inflation rise and the labor market crack and has no clean move to make. That is the stagflation trap in real time. And Friday's number is going to reveal exactly how deep in it we are. Bitcoin climbed back above $80,000 for the first time since January. In a week where missiles are being intercepted in the Persian Gulf, oil is at $114 Brent, and mortgage rates are climbing. Bitcoin going up is either a signal that risk appetite is still alive or a signal that enough people are searching for inflation hedges that even crypto is getting a bid. Depending on which theory you prefer, you can use the same data point to tell completely opposite stories, which is very on brand for Bitcoin. House of Commons Library here is the full picture as of today. The ceasefire is cracking. Israel, Bahrain, and other Middle Eastern countries are reportedly on high alert after the latest missile barrage. Oil is back above $106. Mortgage rates just jumped back above 6.5% in a single morning. The Dow is down 557 points. The jobs report Friday could trap the Fed in a no-win scenario. GameStop is trying to buy eBay. And Bitcoin is above $80,000. Wikipedia welcome to May 2026. The market is doing its best to act normal. Reality keeps showing up and making that very difficult. There is one clean takeaway from all of this. The record highs the market posted on Friday were real, the earnings growth is real, the AI spending is real. But all of it is sitting on top of a geopolitical situation that can reprice everything in a single morning. That is not a reason to panic. It is a reason to know exactly what you own, why you own it, and what your plan is when Monday mornings like this one happen. Because they are going to keep happening. Do you think the market holds through Friday's jobs report? Or does a weak number combined with escalating Middle East tensions finally force the correction that record valuations have been daring the market to have for months? Drop it in the comments, because this week is going to be one to watch very closely.